Said he would never sell. He said it for 5 years on every stage that would have him. Bitcoin was not a trade, it was a religion, and he was the loudest believer in the building. Last week, Michael Saylor sold Bitcoin, and he did not sell it high. He sold it for $11,000 a coin less than he paid for it. Now, the internet decided within about an hour that this was a story about faith. It is not. It is a story about a bill, and once you see the bill, you cannot unsee it, because roughly 200 other companies just signed the same one. Let's do the pylon first because you have already seen it. He capitulated. He never believed it. The top is in. If Saylor is selling, what does he know that we do not? That was the entire conversation, and every version of it is a question about his character. Here is why that framing is so appealing. It is easy. It requires no filings, no arithmetic, and no understanding of how the company actually works. It is also, and I want to be precise here, almost certainly wrong. Because here are the two numbers that break the character story. His average cost across every Bitcoin the company owns is $75,385. He sold at $64,262. That is $11,123 a coin, below his own cost, 1,690 coins, about $18.8 million of realized loss. Now think about that for 1 second. If you are selling because you have lost faith in an asset, you sell it when you are up. You take the win and you tell yourself a story about discipline. Nobody voluntarily crystallizes a loss on the thing they have spent 5 years telling the world is the best asset on earth. Unless they had to. So let me tell you what this company actually is, because this is the part everyone skips and it is the part that explains everything. Strategy, the company formerly called MicroStrategy, is a software business. That is its actual job. It sells business intelligence software to enterprises, and it has done so since the 1990s. It is not a fund. It is not a bank. It is a mid-sized software company that, starting in 2020, decided to also become the largest corporate holder of Bitcoin on the planet. Today it holds 840,447 coins. And here's the question nobody asks. How does a mid-sized software company buy $63 billion of Bitcoin? It does not. It cannot. It has to raise the money. And how it raised the money is the whole story. Machine worked like this, and honestly, while it worked, it was beautiful. Investors were so eager for Bitcoin exposure inside a normal stock that they paid more for Strategy shares than the Bitcoin behind those shares was worth. A premium. So Strategy would issue new shares at that premium, use the cash to buy Bitcoin, and every existing shareholder would end up owning more Bitcoin per share than before. Issue high, buy the asset, everyone gets richer. It is a genuine financial machine, and for 4 years it was the best performing one in public markets. But look closely at what it needs. It needs the premium. Not Bitcoin going up. The premium, that is the fuel. And when the fuel ran out, the company still had to keep the lights on for something it had built in the meantime. Because along the way, Strategy did not just issue common stock. It also issued preferred stock, 4 separate listed series of it, about $15.4 billion worth. And preferred stock is a very different animal. If you own common stock, the company owes you nothing. If you own preferred stock, the company owes you a dividend. In dollars, on a schedule. Forever. That word matters, so I am going to say it again. These are perpetual obligations. There is no maturity date where the problem resolves itself. Every quarter forever, that bill arrives in dollars, and it does not care what Bitcoin did that quarter. It does not care about your thesis. It arrives. So here is the bill, next to the business that has to pay it. In the 3 months ending June 30th, Strategy's software business brought in $122.4 million. Over the exact same 3 months, the preferred dividends came to $400.7 million. Read that again. The dividend bill is 3.3 times everything the company earns. Not 3.3 times profit, 3.3 times revenue. Every dollar that comes through the door, before paying a single engineer or keeping a single light on, is already spoken for more than 3 times over. And both of those numbers come from the company's own filing with the Securities and Exchange Commission. I did not model this. I pulled it. It got there fast. 1 year ago, that same dividend line was $49.1 million against revenue of $114.5 million. The bill was less than half the business. Comfortable. Boring, even. In 12 months, revenue grew about 7%. The dividend obligation grew 8.2 times. That is not a business deteriorating. That is a company deliberately stacking perpetual dollar obligations on top of a software company because the machine that serviced them was still running. 1 ratio, 4 quarters apart, 0.43 to 3.27. And if you annualize where it is now, you get roughly $1.6 billion a year of preferred dividends sitting on a company that generates something like $490 million a year of revenue. I want to be really clear about what that means because it is the crux of the entire video. There is no version of the software business succeeding that closes that gap. None. It could triple revenue and still not cover it, which means the dividends were never going to be paid out of the business. They were always going to be paid out of the machine. In late June, the machine went into reverse. The premium is measured by something called market net asset value, or MNAV. Above 1, the stock is worth more than the Bitcoin behind it, and issuing shares to buy Bitcoin makes every shareholder better off. Below 1, the stock is worth less than the Bitcoin behind it, and issuing shares to buy Bitcoin actively destroys value for the people who already own it. In late June, Strategy's MNAV fell below 1 for the first time. It is still there. The stock now trades at roughly a 21% discount to the coins it holds, and the company's own stated capital policy acknowledges the problem, because below that line it stops treating share issuance as the way to fund things. So put the pieces together. The bill is perpetual, and it is 3.3 times revenue. The business cannot pay it. The share machine that used to pay it is now shut. By the company's own policy, there's exactly one asset left on the balance sheet big enough to pay it. He sold the Bitcoin at a loss to pay a dividend. And here's the detail that turns this from an interpretation into a fact. We know exactly where the money went. The filing says the entire $108.6 million of proceeds was used to buy back 1,152,020 shares of one of those preferred series. He did not sell Bitcoin to raise cash for opportunities. He did not sell Bitcoin because he thinks it is going lower. He sold Bitcoin and handed it directly to the preferred stack. That is not a man losing faith. That is a man paying a bill he cannot get out of. Now let me be honest about the other side, because this is where most videos on this topic cheat. Strategy is not about to collapse. It still holds 840,000 Bitcoin, worth tens of billions of dollars. The sale was about $108 million, which is a rounding error against that pile. Also raised $653 million from common stock in the same window and pushed their dollar reserve up to $4.65 billion. So the company has real liquidity and a lot of room. If Bitcoin rips back above their cost basis, the premium can come back, the machine restarts, and this whole episode gets remembered as smart housekeeping. That is a genuinely possible outcome, and I am not going to pretend otherwise. What I would say is this: that outcome requires the price to bail out the structure, and a structure that only works if the asset goes up is not a strategy. It is a position. Which brings us to the actual reason this matters to you, even if you have never owned a single share of this company. Strategy was not an experiment that stayed in one building. The Bitcoin treasury model got copied aggressively by more than 200 public companies during the years the premium was fat. Same idea, smaller balance sheets, often worse terms. And right now, about a quarter of public Bitcoin treasury companies already trade below 1 times MNAV. One competitor's premium collapsed from roughly 237% in July to about 10%. Another trades at a 63% discount to the coins it holds. Every one of those companies is running some version of the same arithmetic strategy, just ran. And Strategy is the biggest, best capitalized, most sophisticated operator in the entire category. It is the one with the most room. And it is the one that just sold below cost. So the question is not whether Saylor believes in Bitcoin. The question is who in that group of 200 has a bill coming due and no pile big enough to pay it from. So here is what I actually think, and then I want yours. This was never a story about conviction. It was a story about a capital structure that worked perfectly in one direction and has no reverse gear. The bill is perpetual, the business cannot cover it, the premium is gone, and the only thing left to sell is the thing the company exists to hold. And 200 imitators are holding the same map. So tell me below, forced seller or smart housekeeping? Because those two readings lead to very different places, and I genuinely want to know which one you land on. Research and education only, not financial advice. I'm Frankie. One Contra Ryan read a day. Subscribe.